Good afternoon, everyone. My name is Michael Naidrich, co-CEO of Amerivet Securities, and always I am joined by my partner, CFA, all things Fed, liquidity, and rates, Gregory Faranello. Mr. CFA, how are you, sir?
Good afternoon, Michael. I am doing well. Yourself?
I'm doing well, bud. Well, here we are, back where we all started, back to me and you for the last meeting of the year. So let's get right into it, and let's discuss the meeting dynamics, the Fed decision and the summary of the economic projections.
Sure. Thank you for that, Michael. So we largely expect the Fed will go 50 basis points. That's clearly what we're priced for. It is the final meeting of 2022. With this rate increase, it will get the Fed slightly above 4%, between 4.25% and 4.5%. That's their band. And then the summary of economic projections, right, which is probably more important. We don't expect too many changes to the actual statement itself, but in the SEP, the market's going to be looking for a validation of what the Fed has said between meetings, which is that they see the end game, that terminal rate, a little bit higher. And in September, they had indicated that rate to peak at 4.6. So we expect that to move up probably closer to 5%, which is where the market was priced before today's inflation number. And we could talk about that a little bit. Yeah. And then what the trajectory of inflation over time. And keep in mind, the Fed, when they forecast inflation and they forecast employment, their end goal is they have a dual mandate. So they need to get to, at least in their numbers, they need to get to where they need to get to, which is 2% in terms of core PCE. And we see that coming down over time. The Fed has now acknowledged that it's not going to be a straight line. So how they manage that relative to employment, I think the market's going to be watching that very closely to see where they see that number peaking out. And then obviously inflation coming down over a couple of years, but also this notion of holding rates higher for longer. So, a peak terminal rate closer to 5% coming down over time, but perhaps not as quickly as the market is pricing right now.
Yeah, so let's talk about today's CPI reading. That was always a big anticipated number on Thursday. It seems like the whole street kind of stands still until that number comes out. It was very well received at the beginning. We had markets up 3.5% to 4%. We've had a little bit of reversal here later in the afternoon. So maybe if you could speak to the trajectory and meaning of inflation into 2023 versus employment, I think that'd be helpful.
Sure. So in terms of CPI now, we've had 2 month-over-month readings, which have come down. Now, we looked at all the components of today's reading. I mean, it was a soft report across the board. So there's no refuting where inflation has been going, I think, in the short term. If you listen to Chair Powell, November 30th, he gave a speech at the Brookings Institute. I think it was the first time he was very granular in terms of the different pieces of inflation, which we think is very important, where the inflation's been coming from, breaking down those buckets, and potentially where things go into 2023. The first is on the good side of the equation, right? Supply demand imbalances coming out of the pandemic. Today we saw used car vehicles and trucks come down, new cars numbers come down quite a bit. So on the good side, we have seen inflation come down. On the services side, he breaks it down between housing and then non-housing, including things like medical services, transportation services, haircuts, things that are more closely tied to the labor and the wage side of the equation. Now, on the housing side, I think the Fed has been pretty clear, and I think we've been around the marketplace to know that these numbers tend to lag, right? So the interest rate increases that we saw in 2022, the housing market right now, for all intents and purposes, I believe is a little bit frozen. But in terms of rentals and leases, we still have old numbers in the numbers that we're looking at now. So I think the expectation is those numbers will in fact come down into 2023. I think where it becomes more challenging for the Fed is when you look at the non-housing components, which are tied to the labor market and tied to employment. So it will be interesting to see tomorrow what their projection for the unemployment rate is over time. But for all intents and purposes, we believe it's probably going to be difficult to get those components of inflation down without getting the unemployment rate up into 2023.
Yeah, that makes a lot of sense. So let's get into Powell's press conference, and you alluded to it a little bit earlier, but maybe for our listening audience, can you really dig into about talking rates higher and keeping them for a longer period of time?
So this is it, the press conference. What is his tone? We wrote to clients this morning in terms of market location. And I kind of wanted to see where the market was going to be coming out of CPI in terms of his tone potentially versus price action. Obviously, rates are down quite a bit today. Stocks were up quite a bit and have since come off. But to me, there was a tale of two Powells in November. In the November 2nd presser, he was pretty clear that he thought the risk for the Fed was doing too little, right? And then November 30th at the Brookings Institute, he just seemed to have a different demeanor. Maybe it was because he was away from the official meetings, but saying, look, we don't want to really overdo it here. We don't want to break the economy and have to fix it. So we went from a tale of doing too little to potentially doing too much within the course of November. And I think there needs to be some reconciliation there. My view is the reconciliation comes with Chair Powell saying, look, we still have a little bit of work to do. They will clearly direct the market in the SEP in terms of where they see terminal. And keep in mind, that's been a moving target for most of 2022, but we're much deeper in the cycle here. But by saying, look, we're going to go a little bit higher, but we're going to keep rates higher longer than the market may be anticipating. There may be some disparity there in terms of what the market is pricing in terms of forward rate structure versus what the chair actually indicates. Essentially, at the end of the day, Mike, keeping the cost of funding higher is what it comes down to. So that's where we see the potential reconciliation in the marketplace now. But I think the Fed and many of the Fed members have been pretty clear that based on the data that they've seen, and keep in mind, inflation has come down, but overall, they're not going to overreact to one or two numbers. I think they're going to need to see inflation keep coming down into 2023 to have that confidence. So they will signal higher, but I think the real key tomorrow is for them to potentially push back on how long they plan to keep rates high once they get to that peak terminal rate.
Interesting. So what you're saying in a sense is where people might have been looking for a pivot mid next year, you're saying he may go longer than that?
Well, that's it. Pivot versus pause.
Right.
So we do see the Fed pausing at some point, likely in the first quarter. So the way we view it being managed is we went from 25 to 50 to multiple 75s.
Yeah.
They're likely to come down to 50 tomorrow and downshift. But they're likely not going to stop into the beginning of 2023. The way they likely move out of this to an eventual pause is to move down to increments of 25 basis points. And that could be 125 in February. It could be another 25 in March. It could be 125 in February, and then they go to a pause. And Powell may say that, but he's likely to say, look, we don't necessarily know, but this is kind of where it's going. And then the difference between a pause and a pivot, I mean, people use these words interchangeably. I mean, to us, a pivot is, the Fed moving toward easy policy, okay, where they stop tightening and then signal that they're going to cut rates. And I think that's where that disparity lies. They may end at 4 3/4, they may end at 5%, but I think their goal is going to be staying there for a while, and eventually taking rates down. The market is saying they're going up really quick now into 2023, but they're going to start coming down. So we've got into the beginning, late 2023, into the beginning of 2024, we actually have 75 basis points of rate cuts priced into the market right now.
Yeah, it's interesting. I can understand from a psychological point of view where a pause can feel like a pivot because you just want the calmness as opposed to the rates that have been so aggressive over the last year. But there's a pretty big difference between a pause and a pivot. And I think people are going to find that out, in the near future here. All right, one last thing, Bud, talking about the performance of risk assets lately and where you see U.S. Treasuries heading into 2023.
So you and I remember we talked in July, and you said, Greg, what do you think of risk assets the second half of the year? And I said, look, I'm pretty open-minded to where risk assets can actually wind up and trade as the year moves on. With regard to U.S. Treasuries rates in general, we continue to feel that the trajectory of inflation is very, very important here. Now, with regard to different assets, it could mean different things. If you look at equities, clearly, I think the focus is going to be on the real economy, and it's going to be on earnings, certainly, in 2023. So we could see some performance off the back of how that plays out. With regard to U.S. Treasuries, and keep in mind, this curve inversion, I think, is here for the foreseeable future because we are pricing in a slowdown in growth. And at the same time, the terminal rate is bouncing around a little bit. Even the short end has performed really well. But I think an environment whereas inflation continues to come down, even if growth comes down with it and the economy slows, perhaps moves into a recession, is probably a good environment for the Treasury market in general. Now, am I in love with these yield levels right here? Not necessarily. No, we peaked out around 433 and 10-year UST. And as you know, we've been bearish on risk and bearish on rates and treasuries for the better part of 2023. But anytime, 2022 rather, anytime we've seen a move like we've seen, and we've had 3 of these big outsized moves off the lows of 0.25 to 0.50 from 2020 to 2022. Anytime we've had these 150 to 200 basis point moves higher in yield, we've retraced back a good 75 or 100 basis points. And that's what we've done now. So even this morning with the friendly CPI print, 10-year yields inside of 350 seem to be having a bit of a problem. We prefer for better location, but at the end of the day, even if rates do back up from here, I think if the inflation dynamics continue to cooperate, growth comes down in 2023, I think for treasuries in particular, that's not a bad dynamic. And I think in fixed income in general, as you and I know, over the last month and a half, there has certainly been better risk appetite and I think a bit of a tone change.
Yeah, it's really been a historic year, Greg. And I think sometimes when you live it, it's hard to see it. And, you certainly feel it day to day. But I mean, it's been a wild year and, couldn't be any more grateful for you just to sort of, give us your viewpoints throughout the year for us and our clients. It's very meaningful. People are seeing things that they have not seen ever, nonetheless, in a long time. And to have someone who's been there and have a steady hand has been fantastic. I will tell you that, just in talking, between December with the debt markets very slow, probably the slowest it's been in years for this month. It's been a busy month the last couple of years. It is not active right now. It's open, it's just not active. And I think, I think people are still adjusting. I think people are tired, quite frankly. And I think people are like, you know what, I'm going to take a fresh look come January, get one more Fed meeting underneath me and see where it lands with some of this stuff. But, look, you and I have been doing this for 3+ years. I cherish it, as you know. I'm grateful. Wish you and your family a happy holiday season, of course, all of our clients, and look forward to getting back at it January, probably mid-January would be my guess.
Thank you, Michael. I appreciate that.
All right,
Same
man.
to you, and I enjoy these every time as well.
You got it, my man. Happy holidays to all our families. Thank you.
Thank you.